Good afternoon and welcome to this week's edition of Energy Brief. We're going to talk about those issues that are affecting the energy markets today. And right now, when we talk energy, we're talking economy. 2022 started with upward price pressure on diesel fuel, gasoline, kerosene, jet fuel, crude oil, natural gas, all of the fuel products. We also saw upward price pressure on the agricultural commodities, the grains, the fibers. We saw upward price pressure on 1,000 random foot board contracts and all the commodities. We saw upward price pressure in beef cattle, pork. We saw it in dairy. We've seen so much upward price pressure, and the discussions have been readily around economics tables. Where are we in the economic spectrum right now? Are we either heading into or are we already in a recession? The first quarter ended with a negative 1.6% GDP, telling us that if next quarter comes in and we begin to see negative numbers, that we would already be in a recession. I do believe that we are already in that recession. To follow that up, the Atlanta Fed last week changed their projection for the second quarter GDP, announcing that they believe that the number will be minus 2.1% for the second quarter. That would confirm, of course, the fact that we are in a recession. And most folks around the country today will tell you, if you look at your individual economies, we're at that point. As I look at gasoline prices spiked about 2 weeks ago, probably the first maybe 3 weeks ago, with a national average, according to AAA, of $5.01 a gallon for on-highway gasoline prices. Those prices have fallen off since. Diesel fuel, $5.78 and higher per gallon. In some locations like California, we're seeing prices for gasoline in the $6 and diesel into the $7. There's a lot of upward price pressure when you have an inflated type of economy and you have too many dollars pushing too few goods, and then you re-enter with demand that was held back because of a black swan event like COVID-19, the coronavirus. So we start to pour back in demand. It fuels the fire for inflation, and we have gotten ourselves, I say we have gotten ourselves, the economy has gotten itself into a conundrum. We did not have the appropriate action by the Federal Reserve when we needed to have action by the Federal Reserve. The second issue that we dealt with is the Biden administration has an all-out war on fossil fuels, where they're trying to get rid of crude oil, natural gas, coal, the refined products, those kinds of things, in favor of electric vehicles and more electricity to support their grid coming from the renewables like wind and solar. Those are big issues that are at play right now. And the policies with them, the policy decisions with that, has had a dramatic effect, not just on the United States economy, but the world economy, as the United States was known as the de facto leader in the energy market and in the de facto leader in the financial world as well. Both of those are monikers that we wore quite respectfully for a very long time. We've tried to give that away, and in a vacuum of leadership, anybody can step in and take charge. The Saudis don't seem to want to help. OPEC itself is not in a position because they have an unusual dynamic within their organization, with Russia being the plus portion of OPEC plus, and of course the Saudis being the strong hand in OPEC. There are lots of undercurrents here, as well as Vladimir Putin's invasion into Ukraine. It did have a little bit of an effect. However, all it did was augment what was already going on from the Biden administration. It continues to happen here today. As we we finished the first half of the year. We started with 4th of July weekend. We began to look at commodity prices, and today was one of those days. I'm going to highlight it in my meeting notes, because it's a red letter day. I'm paying attention to the fact that we had every single commodity that I look at was in negative numbers today, and significant negative numbers today. I've watched the price of crude oil drop from settled at $120 a barrel back when Vladimir Putin announced his invasion into the Ukraine and the use of nuclear weapons. And today we closed at $98.50 a barrel, a significant drop in the price of crude oil. We've seen the price of gasoline drop from over $5 a gallon according to AAA, was 5.01 a gallon was the peak. And today, I'm seeing a national average here in the United States less than 4.80. After today's action, we'll probably have greater price destruction as we see the commodities, not only the fuel commodities, but the food commodities and the fiber commodities. They all dropped today. That is a signal that tells us that we are facing a recession, if not already in one. And the last shoe to drop would be to keep an eye on the unemployment numbers, which of course come out on Friday, and we'll see if there's been any destruction in the number of jobs and being created in the number of jobs that are beginning to report for unemployment claims. There's a lot of issues here that are at play, and this economy is at that titular point where it can tilt the wrong direction very easily and accelerate in the wrong direction very rapidly. The Fed's next actions coming in July, and they're anticipated to put another 75 basis point increase in the discount rate. If we do see that increase in the discount rate, it could also push the economy just a little bit farther, because that's called a dampening effect. We want to slow the economy. I'm not sure we want to slow an economy that's already slowing. We have to be very careful. This is why the Fed needed to act a long time ago in smaller increments to try to help stave off a disaster of extremely high interest rates and falling economies. These are the issues that we're watching this week. There's quite a few items at play. We'll continue to see how things work over the next 3 or 4 days. And then, of course, next week we'll report back to you on the next week's edition of Energy Brief.